Hello everyone, today our Group 7 will presentation a comparative financial analysis between two companies, Alpha and Beta. Our focus will be on 5 key perspectives: liquidity, solvency, efficiency, and profitability, and market outlook. By analyzing these areas step by step, we'll identify not only the financial health of each company, but also provide an investment recommendation at the end. So let's start with an overlook of this presentation we covered. Our presentation will be divided by 4 parts: vertical analysis, financial ratios, evaluation of financial health, and finally, an investment recommendation with conclusion. So let's begin with the part 1, the vertical analysis. Our goal is to compare with the financial health and investment potential of Alpha and Beta. We will apply vertical and ratio analysis along with the marketing review, focus on liquidity, solvency, efficiency, profitability, and valuation. The aim is to see which company offers a better investment opportunity. So here we can see the results of vertical analysis. On the income statement side, Alpha has a gross margin of about 30% and net margin of 21%. On a comparison, data shows stronger profitability with a gross margin about 33% and the net margin is close to 24%. On the balance sheet side, Alpha is more capital intensive, which is over 65% of assets tied up in property, plant, and equipment. Meanwhile, data relies more on inventory, which makes it more flexible but also less efficient. Overall, it tells us that Alpha represents stability and a long-term investment in assets, while Beta demonstrates a more liquid and profit-oriented approach.
Now let's move on to part 2 of the presentation, which is focused on financial ratio analysis. In this session, we will evaluate Alpha and Beta from 5 key perspectives: liquidity, solvency, efficiency, profitability, and finally, the market viewpoint. By looking at these ratios, we can better understand not just how the companies are performing today, but also how well positioned they are for the future. Let's start with liquidity, which tells us how capable each company is in meeting its short-term obligations. Let's begin with liquidity. Both Alpha and Beta show strong short-term financial health with current ratios above 2. That means each company has more than twice the current assets compared to its short-term liability, which is a comfortable position. Looking more closely, Alpha's credit ratios is slightly stronger at 1.08 compared to Beta's 1.06. This suggests Alpha has a margin edge in quality of its more liquid assets. However, Beta has much larger working capital base, about 144,750 compared to Alpha's 94,100. It gives Beta more financial flexibility to handle an expense or support future expansion. So in summary, Alpha has slightly better liquid assets efficiency, but Beta has bigger financial buffer. Turning to solvency, which reflects long-term stability and debt management, Alpha adopts more conservative financial structure. Its debt ratio is 31.9% and its debt to equity ratio is 0.47. It means Alpha uses less debt financial and therefore carries lower financial risk. Beta, on the other hand, is more leveraged. Its debt ratio is higher at 35.8% and its debt to equity ratio is 0.56. Why this increases risk? It also has the potential to boost returns if the company performs well. Looking at interest coverage, both companies are in very strong position. Alpha covers its interest expenses 23 times over, while beta still have a healthy coverage of 19 times. Overall, alpha is safer and more conservative choice, while beta taking on more risk for potential growth. Less efficiency, which shows how well each company uses its resources. Alpha is clearly stronger in managing receivable and inventory. It collects cash from customers in just 18 days, compared to Beta's 25 days. And when it comes to inventory, Alpha turns it over every 47 days, while Beta takes a much longer, 74 days. It highlights Alpha's operational disciplines and tighter control over working capital. However, when we shift to total assets turnover, Beta comes out ahead. Its ratio is 1.9, versus Alpha's 1.83. This means Beta generates 9 more sales per dollar of total assets, making it more effective overall at leveraging its asset base. In short, Alpha is better at managing specific assets like receivable and inventory, but Beta has the edge in overall asset efficiency.
Hello everyone, I'm Li Tai, and I will now continue with the slide 9 to 11 of part 2 of our presentation. Slide 9. When we look at profitability, Beta does better than Alpha in most parts. Its gross margin and the net margin are higher, which means it controls costs better. Beta also gives a higher return on asset and equity, so it creates more value for the company and for shareholders. Overall, Beta makes more profit and gives better return than Alpha. Slide 10. For the market view, Beta is more attractive. Its PE ratio is lower, which means investors pay less for each dollar of profit. Both companies give the same dividend yield of 5.07%, so investors get the same cash return. Overall, Beta has a better value and a stronger profit, while Alpha is more expensive because it is seen as lower risk. Slide 11. Summary. To summarize part 2, Alpha is safer with better liquidity. Beta is bigger, make more profit, and use its asset better. Both companies are strong, but Beta has better value and gives higher returns. So Beta is the more attractive choice for investors. That's the end of my presentation. Now my teammate will continue with part 3.
Hello everyone, today I'm going to talk about comparative financial health assessment of Alpha and Beta, covering liquidity, solvency, efficiency, profitability, and finally the market's perspective on both companies. First, liquidity. Both companies are in an excellent position to cover their short-term obligations with current ratio well above the standard benchmark of 2, while their current ratio are almost identical. Alpha's slightly higher quick ratio suggests it has a marginal advantage in immediate liquidity, as it relies less on inventory to pay short-term debits. Looking at the long-term solvency, both companies are financially safe and stable. The key takeaway here is that Alpha operates with a noticeable lower level of leverage. Its lower debt ratio and significantly higher times interest earned ratio indicate a more conservative capital structure and consequently a reduced financial risk profile. Our efficiency metrics tell a nuanced story. Alpha is clearly more efficient in its operations, converting its receivable to cash 7 days faster and turning over its inventory much more quicker than Beta. However, Beta fights back with a stronger asset turnover ratio. This tells us that while Alpha manages this is where beta truly shines. As you can see, beta constantly outperforms alpha across every major profitability metric. It maintains higher margins on its sales and, most importantly, delivers significantly higher returns on both assets and equity. From a pure profitability standpoint, beta is a clear leader. The market views these companies through different lenses. They offer identical dividends yields, making them equally attractive for income investors. However, their PE ratios reveal a different strategy. Alpha's higher multiple suggests the market values its odds premium saver investment. Beta's lower PE indicates it's seen as a better value with stronger growth potential priced into its stock.
Let's start with profit. Beta make more money from sales. Its gross profit margin is 33% higher than Alpha's 30%. The net profit margin is also better, about 23%, 9% compared to Alpha's 21.1%. This means Beta keeps more money from easy sale. If we look at return on assets, Beta has 50.9%, while Alpha has only 42%. This shows Beta uses its assets more wisely to make money. Return on equity is also higher, 65% versus 55.8%. So investors get more return from their money. Now about the efficiency, Alpha does a good job with receivable and stock, but Beta still has higher total assets turnover, 1.9 times, whereas Alpha 1.92. This means Beta sells more with the same amount of assets. Overall, Beta is better because it makes more profit and uses its resources well. This makes it more power to grow and pay investors in the future. Now let's talk about the safety market value and growth. Beta has a little more debt than Alpha, 36% compared to 32%, but Beta can pay its interest 19 times with its earnings. This shows the debt is not a big risk and the company is still safe. Let's say the market Beta price to earnings is 13.7, while Alpha 16.6. A lower number means Beta is cheaper for the same earnings. Both companies pay the same dividend 5.07%. So investors get the same cash return, but since Beta is cheaper, it's gives more value. Finally, grows because Beta makes more profit and use money well. It has a strong base to expand in future. It can give a stable cash now, though a dividend, and also give hope for higher stock price later. To end, Beta give us three things: a profit, safety, and growth. That is why Beta is the better choice for investors.
Thank you. This is our presentation.